Hello and welcome to Talk the Walk. I'm Azam Khan. China's growth has been under the spotlight as it reopens from pandemic restrictions that were in place for nearly 3 years, exceeding expectations at 4.5%. The IMF recently forecasted that China will be the largest driver of global economic growth in the next 5 years, accounting for 22.6% of global growth, double that of the United States. With the backdrop of the US-China trade war, looming global banking woes and inflation, and Europe trying to strike a balance amidst US decoupling strategy in certain sectors, the global economic outlook is a fluid situation to say the least. My guest today to make sense of all the noise is James Fok, a veteran financial and strategic advisor who has served as a senior executive at Hong Kong Exchanges and Clearing from 2012 until 2021. He is also author of a book, Financial Cold War, A View of Sino-US Relations from the financial markets. Mr. Fok, thank you so much for taking the time to speak with me.
Great to be here, thank you.
It seems like the opening up, which coincided with President Xi's third-term re-election, China has really hit the ground running with its restarting a lot of trade relations, with the IMF's strong forecast growth. So what do all these macro developments signal for the country when it's trying to strike a balance?
Well, I think, first of all, notwithstanding the growth number that you referenced that's just come in, China's economy has been really badly hit by COVID. And so Chinese policymakers are on a real drive to push economic growth to make sure that the population continues to see an improving level of prosperity. The second issue at play right now is also amid the geopolitical tensions, particularly with the United States, China needs to ensure that it secures its access to commodity imports on which it's very dependent. It doesn't produce enough food to feed itself. It doesn't produce enough energy to keep the whole country going. And it's very dependent on imports for these. And so in these kind of pushes that it's doing now, it's basically trying to kickstart the economy again, but also go through a period of economic transition from one that's very investment-led to one that's going to be more driven by consumption demand in China. And at the same time, they're trying to make sure that they can secure the Chinese economy against potential weaponization of the financial system.
Right. What about the significance, also on top of what you mentioned, the consumption demand, what about the significance of the growing youth unemployment? I believe it's roughly around from the ages of 18 to 24, as well as the structure of its population demographic. Are these also significant factors for it to strike its balance?
Yes, absolutely. Look, China's got the fastest aging population of any major economy. And so it is now moving from a position where it's got roughly 7 working age population to every dependent to, by 2050, that's going to be about 2.1 working age population per dependent. This is going to put a big strain on the system. And so the economy really needs to transition. And it means that they're going to have to automate a lot. The sort of big dividend from a large labor force now has largely worked its way through. The country is going to have to depend much more on automation for labor. And it's also going to have to transition from one that's much more, that was very dependent on having a cheap labor force to drive exports, to one where a lot of the growth is being driven by domestic consumption.
When you have all of this already, how do you see China advancing or evolving its financialization of its economy in the near future? Do you think it'll be a gradual process, or is it something that they may wait out as they establish more the yuan currency for global exchanges?
Well, first of all, I think, to be absolutely clear, financialization of the economy is not one of Chinese policymakers' objectives. for them, the financial markets have to serve the real economy. And so to the extent that they're opening up the capital markets, internationalizing the capital markets, that's very much to serve their real economic needs. And it's tied to that question you asked about, the changing shape of the population. As the population gets older, inevitably social welfare spending needs are going to increase, which means that the Chinese government may have to depend more on international markets for borrowing. The second thing is that also they want to make sure that Chinese savings go into higher returning assets that can help cushion that increased burden on the state, which means that when you look at China's kind of allocation of its wealth today, the largest single asset for Chinese households is residential real estate. The number two holding is in cash deposits at banks. This is an amount that it stands at about 37 trillion US dollars. Relatively, the amount of money invested in stocks and bonds is very small. What they want to see is more of those deposits getting invested in the capital markets where they can get a higher return. Now here, China has a real challenge. The domestic markets, because they've been relatively underdeveloped, can't absorb anywhere near that amount of capital or even a significant portion of those savings without generating big asset price bubbles. So necessarily, China is going to have to invest more internationally. And so, one of the ways that they try to do that is through the Belt and Road Initiative. But the Belt and Road Initiative, I think, has suffered from the fact that it's very dependent on Chinese corporates, particularly state-owned entities, going out and buying large assets, investing in infrastructure in other countries, where there's frankly been a lot of sensitivity about the level of Chinese government influence that entails. And so what China's trying to reposition to do is to have more individual portfolio investment by institutions investing the pension savings of Chinese investors, make that investment on their behalf. That was one of the major drivers behind the creation of the Stock and Bond Connect programs with Hong Kong. The question now is, how does China extend that a step further to allow Chinese investors not just to invest in investments here in Hong Kong, but to go further afield?
I wanted to get your opinion on how inflation has been kept somewhat in check in China. How has this been able to be achieved?
Actually, China's susceptible to all the same forces that other countries are vis-a-vis commodity price inflation. China's very dependent on imports of oil, imports of grain and other foodstuffs. But where China has differed, particularly from the United States, is that the People's Bank of China has been very conservative around the expansion of the money supply. So there's not been all this kind of money being sort of flooded into the market through quantitative easing. And also through the COVID period, China didn't engage in anywhere near the level of fiscal stimulus that the United States did. And so, yes, China will experience inflation from commodity prices going up, but vis-a-vis just general inflation from just a lot more money having been printed,
thrown in.
China's not suffering from that right now.
Domestically, how impactful has the US's drive to ensure that there's companies from strategic industries that are trying to decouple from China and the pressure that they face within China? Do you think this will accelerate China's own capabilities domestically in certain industries?
decoupling is, I mean, it's at best been a mixed success from the point of view of the United States, because the reality is that the trade balances are still growing. Right. They hit a record level of 690 billion last year, and what's more, Chinese exports to the United States grew by over 6%. So it's difficult to see any decoupling there. But where I think the decoupling will affect the two countries is around higher end technology. And there's definitely been moves on the part of the United States to limit China's access to high technology imports. And to answer your question, this will certainly incentivize the Chinese government and Chinese corporations to try and develop more self-sufficiency around these technologies. But I think that there's one thing which is also quite important here. There's obviously talk of US-China decoupling, but you also have to consider the positions of other countries. And the reality is that many other countries don't necessarily want to go along with these US restrictions on Chinese technology imports and other things, because in an open and competitive market, Chinese companies have been producing very high quality products at an attractive price point. And so the question really then becomes, what will those other countries do?
Right. Mr. Fok, I'm going to have to pause you there for 1 second while we take a quick break. Don't go anywhere. We'll be right back with James Fok. Stay tuned. Welcome back to Talk the Walk. I'm speaking with financial and strategic advisor, James Fok. Mr. Fok, I wanted to get your opinion on the fact that since the conflict, there's been early signs of not only China, but the global South having to pivot and veer away from the US dollar. And you have things like Brazil now planning to trade in the US dollar with regards to oil and gas, and just other significant changes that moves away from US hegemony. So what will all that mean within the context of US-China tensions going forward?
Well, look, the fact is that the unprecedented financial sanctions that have been put on Russia since its invasion of Ukraine have really spooked a lot of countries that either hold a lot of US dollar reserves or who depend on the dollar for their trade and financial interaction with other countries. This has no doubt increased the incentive for them to try and diversify away from the dollar. But any illusion that the dollar is going to be usurped by some other currency, certainly within the near term or foreseeable future, I think is vastly overblown. Nevertheless, the fact is that the United States' weaponization of the dollar system is pushing other countries to try and find alternatives.
Right, but even very recently, the Malaysian Prime Minister was over in Beijing, and he was talking about wanting to dump the dollar and set up an Asian monetary fund. And then you have Lula Silva, the president of Brazil, over in China and speaking more about the need to trade in yuan more. So do you think there's no steam even in potentially the BRICS trying to come up with a global currency, trying to come up with their own currency?
If you look at the BRICS, I think it's actually, although they've become economically much more significant, they've now overtaken the G7 as a share of global GDP.
That's right. The IMF recently reported that.
But the fact is that other than India, all of the other BRICS countries are net exporters. And so for them, for them, unless they radically transform and become major net consumers and major net issuers of their own currencies or some other common currency unit security.
Wanted to get your opinion on the impact on the global financial markets when you see China, Beijing and Riyadh and the Gulf states enhancing their cooperation with talks to trade into yuan as well, China making more inroad diplomatically with the Gulf states, coming up with peace proposals between Saudi Arabia and Iran, etc. So how does this all also fit into the whole dynamic?
Well, that's a very good question, because a big driver of the US dollar's status today was the petrodollar phenomenon that began really in earnest in the 1970s. And that was a deal that ultimately rested on an assumption that the United States would always be dependent on Middle East oil. And in return, the United States provided a big security umbrella over the Middle East. The innovation of shale oil technology has just completely blown that situation or state of affairs up. The US is now a major export competitor of Saudi Arabia and other petroleum exporters in the Middle East, which means that, and at the same time, China has become the largest export customer for those countries. So inevitably, the relationship between China and those Middle East countries is becoming and will become closer, ever more connected. The question now, though, is that China, for financial and other security reasons, wants to increase the use of its own currency to settle the payments for those oil imports that it's bringing in from those countries. And in order for it to do that, there needs to be a large and liquid market in renminbi securities in the offshore system for those recipients of renminbi to reinvest those proceeds. And this is something which doesn't yet exist, but which I believe is something that those countries are now focused on, whether or not, and if so, how they create.
Right. I want to shift the focus to Hong Kong and get your opinion on going forward, how Hong Kong can expand its role as a leading global financial center.
The big changes are that for quite some time now, China has no longer needed to bring in that capital. China has abundant domestic savings to meet the financial needs of its corporations. If anything, China now has the problem, as we spoke about earlier, about how to invest more of its savings internationally. And I think that Hong Kong, the reason why international investors chose to come through Hong Kong to invest in China was because they perceived that Hong Kong provided a greater level of convenience and a greater level of legal security and regulatory security for them. Actually, that makes Hong Kong, under one country, two systems, ideally suited to serving the same functions for Chinese investors going out into other markets. But that means necessarily a change in mindset in the Hong Kong financial services sector to start focusing on a different clientele and different functions within the financial services industry.
And this also leads to the fact of, and there's been a lot of emphasis on Hong Kong being an IPO hub, and that aligns to exactly the role of what you were mentioning just now. But is it a silver bullet?
The reality is that certainly Hong Kong needs to diversify and create a broader base in its financial services industry. But to give you perhaps one example to illustrate this, the fact is that investors investing across borders into China and Chinese investors investing out, they want to be able to borrow against those securities and use those securities to meet margin requirements in clearinghouses around the world. One of the major challenges right now is that there are very few international investors who are willing or comfortable to take a pledge of collateral under mainland Chinese
Directly
law.
to it. Yeah.
Whereas they're very comfortable under the common law system that we operate here in Hong Kong to do so. And equally, when you look at some of the countries where we're likely to see a greater amount of investment, say the Middle East, well, actually, one of the problems facing those countries is under Sharia law. It's very difficult because you can't pay or accept interest.
Islamic banking.
Yes, you can't pay or accept interest. And so actually those countries or those countries' financial centers are not necessarily ideally suited to serving the rehypothecation needs of investors. And Hong Kong actually in this has, under one country, two systems, a unique competitive advantage that it can exploit to expand its financial services offering. So what we're talking about is essentially Hong Kong moving from the front office of financial services doing the IPOs to deepening its offering in the middle and back offices of the financial services system.
In the first quarter, the number of IPOs in Hong Kong had actually plummeted significantly, and that was due to a lot of different factors, a banking crisis in Europe, and what have you. Do you see that changing by the end of the year?
I think the IPO market will be cyclical. At the moment, we've seen quite a lot of risk-off feeling by the international investor community vis-a-vis Chinese investments, which are the predominant securities that are being listed here in Hong Kong. The Hong Kong Exchange at the moment is working very hard to try and increase the number of international listings that it can attract, although in doing so it faces a number of challenges, not least amongst these geopolitical tensions. The reality is that it also now needs to work out, as renminbi continues to internationalize, it's not just going to internationalize in Hong Kong, it's going to internationalize all over the world. And in derivatives markets where these things ultimately rest on contracts, the contracts can be written anywhere. It's not like a share or a bond where there's a location of listing and you have to go there if you want to buy and sell it. So in this, Hong Kong needs to work out how it plays a role in intermediating that business where the derivative traded or the activity is happening outside of our immediate market.
James Fok, thank you so much for taking the time to speak with me.
Thank you very much.
That's all the time we have. We'll see you same time next week. Goodbye.